Every day, somewhere between 150 million and 200 million ounces of silver trade hands on the COMEX. That's the commodity exchange, the division of CME Group that handles precious metals futures, 150 to 200 million ounces daily. Here's the problem. COMEX registered inventory, the actual physical silver sitting in approved warehouses available for immediate delivery against futures contracts, currently holds around 113 million ounces as of December 2025. Do the math. Daily trading volume of 150 million ounces against registered inventory of 113 million. That's a ratio where the paper market trades more silver in a single day than exists in deliverable form. This isn't a glitch. This is the system. The COMEX silver market operates as a fractional reserve, paper contracts representing claims on silver that doesn't exist. And this paper market, this derivative casino built on leverage and promises, sets the price for the entire global silver market. Every coin dealer, every industrial buyer, every mining company, they all reference COMEX futures prices. The paper tail wagging the physical dog. But here's what should terrify anyone holding physical silver or betting on silver's future. Historical data shows that fewer than 2% of precious metals futures contracts result in physical delivery. The other 98%, cash settlement or contract rollover. The system functions because almost nobody actually demands the metal. They settle for dollars instead. This works brilliantly until it doesn't. And right now in December 2025, with silver pushing above $59 per ounce, with lease rates spiking above 11%, with registered inventory at historic lows relative to open interest, the system is showing cracks. Let me show you exactly how the COMEX silver market actually works, how paper contracts suppress physical prices, why the leverage is mathematically unsustainable, what happened when someone tried to break the system in 1980, and why the same breaking point might be approaching right now. Because understanding COMEX isn't academic. This is the mechanism that determines whether silver breaks out to triple digits or gets crushed back to $20. And the people running this system, the major banks with massive short positions, they'll change the rules mid-game to protect themselves. They've done it before. The COMEX silver futures contract is standardized. Each contract represents 5,000 troy ounces of refined silver, meeting specific purity standards, minimum 999 fine silver. These contracts trade electronically on CME Globex almost 24 hours a day. Settlement occurs through an auction process during specific trading hours, typically between 1:24 p.m. and 1:25 p.m. Eastern Time for the active contract month. The contract structure allows two outcomes at expiration: physical delivery or cash settlement. Physical delivery means the buyer receives warehouse receipts for actual silver bars stored in COMEX-approved facilities located in Delaware, Illinois, and other designated locations. Cash settlement means the buyer receives or pays the cash equivalent of the price difference between their entry point and the final settlement price. Here's the critical insight. The system is designed around the assumption that physical delivery will be rare. CME Group and the major banks participating in this market built the structure knowing that most traders don't want physical silver. They want price exposure. They want to speculate on silver going up or down without dealing with storage, insurance, transportation, and all the logistics of actual metal. This assumption creates the leverage. If only 2% of contracts demand delivery, then the exchange only needs enough registered inventory to cover 2% of open interest. The other 98% rolls forward into future contract months or settles in cash. It's fractional reserve banking applied to commodities. Current data proves this. As of early December 2025, COMEX silver open interest, the total number of outstanding futures contracts, sits around 130,000 to 180,000 contracts, depending on the month. Each contract represents 5,000 ounces. That's 650 million to 900 million ounces of paper silver. Registered inventory sits at 113 million ounces. If even 15% of contract holders demanded delivery, the system couldn't fulfill it. There isn't enough metal. But the system has a safety valve: exchange rules. COMEX maintains broad authority to modify contract terms, delivery procedures, and settlement mechanisms during market stress. Translation: if too many people demand physical delivery, the exchange can force cash settlement, change margin requirements, or implement position limits. They control the game board. They can change the rules if they're losing. This isn't conspiracy theory. This is documented procedure, tested in actual crisis scenarios. The Hunt brothers learned this lesson the hard way in 1980. Let me tell you that story because it's the blueprint for understanding how COMEX protects itself. Nelson Bunker Hunt, William Herbert Hunt, and Lamar Hunt were sons of Texas oil billionaire H.L. Hunt. In the 1970s, facing double-digit inflation, collapsing dollar purchasing power, and geopolitical chaos, they decided silver was the ultimate hedge. Not paper silver, physical silver. Starting in 1973, they began accumulating. Physical bullion, stored in Switzerland, transported in specially designed airplanes guarded by armed Texas ranch hands. But physical accumulation was slow and expensive, so they added silver futures contracts, massive positions on COMEX using leverage. By 1979, the Hunt brothers controlled an estimated 100 million ounces of physical silver and futures contracts, representing another 150 million ounces. That's 250 million ounces total, roughly one-third of the world's privately held silver supply, and their strategy was working. Silver prices surged from 6 per ounce in early 1979 to $21 by late 1979. By January 21, 1980, silver hit $50.35 per ounce. The Hunt brothers' position was worth over $10 billion on paper, but institutions on the other side of those contracts, the shorts, were getting obliterated. Banks, commodity trading firms, and COMEX member companies had sold silver futures, assuming they could always buy back cheaper or deliver from available stockpiles. But the Hunts kept demanding physical delivery. They weren't rolling contracts. They were taking metal off the market. COMEX was facing a crisis. Registered silver inventory couldn't cover the delivery demands if the Hunts and other longs actually stood for delivery. The exchange was staring at potential default, so they changed the rules. January 7, 1980, COMEX enacted Silver Rule 7. This emergency rule restricted silver futures positions. Any single entity could hold no more than 50 contracts in January and February delivery months and 500 contracts in later months. More critically, on January 21, 1980, the same day silver hit its all-time high, COMEX and the Chicago Board of Trade limited trading to liquidation orders only. You could sell silver futures, but you couldn't buy. Think about that. The exchange suspended the fundamental mechanism of a market, buying, because one side was winning too hard. And the new rules had a targeted effect. The Hunt brothers, who had financed their massive positions with borrowed money, suddenly couldn't maintain their leveraged longs. Margin requirements increased, lending dried up. They were forced to sell into a one-way market. March 27, 1980, Silver Thursday, silver prices collapsed from $21.62 to $10.80 in 4 days. The Hunt brothers couldn't meet margin calls totaling over $100 million. They faced bankruptcy. The entire financial system, worried about cascading defaults to brokers and banks that had lent to the Hunts, panicked. Eventually, a consortium of banks provided a $1.1 billion bailout to prevent wider collapse. The Hunt brothers were later found guilty of market manipulation, fined, and their wealth destroyed. But here's the lesson. They didn't manipulate the market. They just demanded physical delivery of contracts they owned. The manipulation was the exchange changing rules mid-game to protect the shorts. And the mechanism COMEX used in 1980, emergency rule changes, forced liquidation, position limits, it still exists today. Exchange rules explicitly grant CME Group authority to modify contract specifications during market emergencies. They can force cash settlement if physical delivery threatens market stability. This is the sword hanging over anyone betting that silver's paper market will break and force physical prices to explode. COMEX can and will change the rules to prevent their own default. Fast forward to 2025. The setup rhymes with 1980, but the scale is larger and the pressure points are different. Open interest in COMEX silver currently represents around 650 million to 900 million ounces, depending on the month. Registered inventory sits at 113 million ounces. That's a coverage ratio of 12% to 17%. For every ounce of deliverable silver, there are 5 to 8 ounces of paper claims. This worked fine when silver was trading at $20, $25, $30 per ounce. At those price levels, most traders were speculators betting on price movements, not industrial buyers or investors demanding metal. But at $59 per ounce, dynamics change. Industrial users, electronics manufacturers, solar panel producers, electric vehicle battery makers, they need physical silver, not cash-settled contracts, actual metal to put into products. When futures prices are $59 and physical premiums are $3 to $5 over spot, it's cheaper to demand delivery from COMEX than buy from dealers at $62 to $64. Investment demand is surging too. Silver ETFs saw net inflows of 95 million ounces in the first half of 2025, already exceeding all of 2024. These ETFs, especially physically backed funds, must buy actual metal. They can't settle in cash. Global silver ETP holdings reached 1.13 billion ounces by mid-2025, just 7% below the all-time high from February 2021. And central banks, sovereign wealth funds, and institutional buyers are demanding physical delivery instead of cash settlement. This is new. According to market data, delivery rates on precious metals futures have increased 45% year over year since 2020. People are actually standing for delivery. This creates the squeeze. Open interest is high, inventory is low, and delivery demand is rising. If 20% of open interest demanded physical delivery, That's 130 million to 180 million ounces. COMEX only has 113 million ounces registered. The math doesn't work, but the market has mechanisms to prevent this from becoming catastrophic for the shorts. Let me show you how the price suppression actually functions. The key players in the COMEX silver market are commercial entities, large banks and trading firms that hold massive short positions. According to CFTC Commitment of Traders reports, commercial traders, the category that includes major banks, have consistently held net short positions in silver futures. These aren't small positions. Estimates suggest total commercial short interest can represent 200 million to 400 million ounces of silver. Why would banks short silver? Because they're on the other side of speculative long positions. When hedge funds, managed money, and retail traders buy silver futures betting on higher prices, someone has to take the opposite side. Banks provide liquidity by selling contracts. They profit from transaction fees, bid-ask spreads, and the statistical likelihood that most speculators lose money. But there's a deeper reason. Major banks often have physical silver inventory, either owned outright or held in custody for clients. They can hedge physical holdings by shorting futures. Or they can engage in arbitrage, buying physical at one price and selling futures at a higher price, pocketing the spread. JPMorgan Chase is the poster child for this strategy. In September 2020, JPMorgan paid $920 million to settle criminal charges related to spoofing in precious metals markets. Spoofing is placing fake orders to manipulate prices, then canceling before execution. The Department of Justice documented years of manipulation, but the settlement also revealed the scale of JPMorgan's silver operations. Reports suggest JPMorgan accumulated massive physical silver positions after 2011, potentially holding 40% or more of COMEX registered inventory at various points. If these reports are accurate, and they're supported by multiple sources tracking warehouse movements, JPMorgan is the single largest holder of silver in the COMEX system. This creates a unique position. When silver prices rise, JPMorgan's physical holdings gain value. But if JPMorgan also holds short futures positions, they can suppress paper prices while accumulating physical, sell futures contracts to cap prices, buy physical silver with the proceeds. Over time, physical holdings grow while paper prices remain controlled. This isn't theoretical. Market observers have documented patterns where large sell orders, often during low-volume trading hours, drive silver futures prices down sharply. These flash crashes don't correspond to fundamental news. They're mechanical price suppression through concentrated selling. The October 2025 COMEX delivery data showed extreme delivery volume for a minor month, representing 250% of peak open interest. This means people who normally would roll contracts forward are instead demanding metal. This forces shorts to either deliver metal they don't have, buy contracts back at higher prices to close positions, or face default. When delivery pressure increases, lease rates spike. Silver lease rates, the cost to borrow physical silver for short-term use, hit 11% in London during October 2025. Normal rates are 1% to 3%. An 11% lease rate means there's a shortage of available physical silver for immediate delivery. Entities that lent silver are charging punitive rates because they're not confident they'll get the metal back. And here's the critical connection. Lease rates above 10% historically signal physical market stress. The paper market can trade billions of ounces daily. But if actual metal can't be sourced for delivery, the paper prices become fiction. This is backwardation, when spot prices or near-term futures trade higher than longer-dated futures. It means immediate delivery is more valuable than future delivery. This only happens when physical supply is genuinely tight. Now let me show you why the leverage is unsustainable. The total above-ground silver supply globally is estimated at around 1.7 billion ounces, according to USGS data. This includes coins, bars, ETF holdings, industrial stockpiles, everything. Annual mine production is approximately 835 million ounces, but much of that is byproduct from base metal mining. Primary silver mine production has been flat or declining for years. Industrial demand in 2025 is projected to hit 665 million ounces. Solar panels alone consume roughly 200 million ounces. Electric vehicles add another 90 million ounces. Electronics, medical devices, batteries, all adding to demand. Meanwhile, investment demand through ETFs, coins, and bars adds another 200 million to 250 million ounces. Total demand, approximately 900 million to 950 million ounces. Total supply, approximately 835 million to 900 million ounces when you include recycling. That's a structural deficit of 50 million to 100 million ounces annually. This is the fifth consecutive year of deficit, according to the Silver Institute. Where does the shortfall come from? Above-ground inventories. Stocks drawn down from vaults, ETF redemptions converted to industrial use, recycled material. But those stocks are finite. Each year of deficit means less available inventory. COMEX registered silver fell from 85 million ounces in mid-2022 to 113 million ounces in December 2025, briefly rebounding from lows below 40 million ounces in mid-2025. This volatility shows the system is stressed. Meanwhile, the paper market trades as if supply is unlimited. COMEX alone facilitates trading volume of multiple billions of ounces annually. Add the London over-the-counter market, Shanghai Futures Exchange, and other venues, and you're looking at 50 to 100 times annual physical production traded as paper derivatives. This leverage worked when physical supply was ample and industrial demand was moderate. But with 5 consecutive years of physical deficits, with industrial demand accelerating from green energy transitions, with investment demand surging due to inflation fears, the paper market is increasingly disconnected from physical reality. And here's the danger point: confidence. The fractional reserve system works only as long as participants believe they can convert paper to physical when needed. Once that confidence breaks, once buyers realize that demanding delivery might trigger cash settlement or rule changes instead of receiving metal, the paper price becomes meaningless. We're seeing early signs of this breakdown. Physical silver premiums over COMEX spot prices have widened. Retail silver eagles carry premiums of $8 to $10 over spot. Generic rounds carry $5 to $6 premiums. These premiums used to be $1 to $2. The spread between paper and physical is growing. Delivery times are extending. Mints report 8 to 12 week lead times for large orders. Refineries are quoting similar delays. This isn't normal. In a functioning market with ample supply, delivery should be days, not months. And backwardation keeps appearing. Spot prices trading above futures, near-term contracts trading above distant contracts. This pricing structure signals shortage. When the market expects tightness to ease in the future, near-term prices should be lower. But when near-term is higher, it means the market expects physical scarcity now that might not resolve. The question isn't whether the COMEX leverage is sustainable, it's not. The question is what breaks it. Does delivery demand overwhelm registered inventory, forcing exchange intervention and rule changes? Does a major bank default on delivery obligations? Does confidence collapse, causing mass exodus from paper to physical? Any of these triggers, the same outcome. COMEX either defaults, admitting they can't deliver against contracts, or they change rules to prevent default, force cash settlement, implement position limits, suspend trading, the Hunt Brothers playbook. And when that happens, when the paper market is exposed as fractionally reserved fiction, physical silver prices decouple. The COMEX futures price might be $60, but physical dealers are selling at $100, $120, $150, whatever clears the market based on actual supply and demand. This has happened before in other commodities. In March 2022, the London Metal Exchange faced a nickel short squeeze. Prices surged from $25,000 per ton to over $100,000 in hours. The LME suspended trading, canceled trades, and implemented emergency rules. The exchange chose to protect shorts rather than honor contracts. It destroyed confidence, but it prevented defaults that would have bankrupted LME member firms. COMEX will do the same for silver if forced. They'll protect the system at the expense of longs demanding delivery. This is the uncomfortable truth. Owning COMEX silver futures is not the same as owning physical silver. When the system is stressed, futures holders get cash. Physical holders get metal. So where does this leave us? Silver at $59 per ounce in December 2025. Open interest at 650 million to 900 million ounces. Registered inventory at 113 million ounces. Industrial demand at record levels. Investment demand surging. Lease rates spiking. Physical premiums widening. Delivery times extending. The setup is complete. The COMEX leverage is maximum. The physical deficit is structural. The question is timing. Does the break happen in 2026, 2027, later? History suggests the break comes suddenly. The Hunt Brothers scenario played out over months, but the final collapse was days. Silver Thursday saw a 50% price decline in 4 days. Once confidence breaks, the unwind is violent. But here's the key difference between 1980 and now. In 1980, the Hunt Brothers were isolated. 3 billionaires fighting the system. When COMEX changed the rules, they had no allies. Today, physical demand is global. Central banks, sovereign wealth funds, industrial users across multiple countries, all demanding metal. COMEX can change rules for American participants, but they can't stop Chinese buyers, Indian importers, or Middle Eastern sovereign funds from demanding physical. This internationalization of demand makes rule changes less effective. You can force American speculators into cash settlement, but you can't force industrial users to accept cash when they need metal for solar panels. They'll just buy from Shanghai or London instead, draining those markets and exposing COMEX as irrelevant. The endgame isn't COMEX default. The endgame is COMEX irrelevance. When physical markets in Asia, Europe, and Middle East set prices based on actual supply and demand, and COMEX becomes a paper casino disconnected from reality, The center of gravity shifts. Price discovery moves from New York to Shanghai, London, Dubai, wherever physical clears. We're watching this transition happen in real time. Shanghai Gold Exchange already handles more physical gold delivery than COMEX. Shanghai Futures Exchange, silver volumes are growing. These exchanges require physical settlement, not cash. They're building the infrastructure for a post-COMEX world. And when that shift completes, when COMEX is no longer the benchmark for global silver prices, the paper leverage collapses. Because if COMEX futures don't determine physical prices, why would anyone trade them? The game only works if everyone accepts that paper sets the price. Once physical markets reject that premise, the paper market becomes irrelevant speculation disconnected from the commodity. Let me be clear about what I'm not saying. I'm not predicting that silver goes to $100, $200, $500 per ounce tomorrow. I'm not claiming COMEX defaults next week. These are complex systems with sophisticated participants who will fight to maintain control. What I am saying is this. The COMEX silver market operates on fractional reserve leverage. Open interest vastly exceeds registered inventory. This works only because 98% of contracts settle in cash. But structural deficits, rising industrial demand, surging investment demand, and growing physical delivery pressure are stressing the system. Lease rates above 10%, physical premiums of $8 to $10, delivery times of 8 to 12 weeks. These are symptoms of a system under strain. And when systems are strained, they break, not gradually, suddenly. The Hunt brothers went from $10 billion on paper to bankruptcy in months. Lehman Brothers was solvent until it wasn't. Silicon Valley Bank was fine until it collapsed in 48 hours. Complex systems fail at the margins, then all at once. The COMEX leverage is the margin, and it's thinner than it's ever been. So what do you do with this information? That's not for me to say. I'm showing you the mechanics, the data, the historical precedent, understanding how paper silver controls real prices, how the leverage works, how the system protects itself, and how it might break. That's the analysis. But the choice, whether to hold paper or physical, whether to bet on the system holding or breaking, whether to trust COMEX or trust your own vault, that's yours. Just know that when the Hunt brothers trusted the system, trusted that contract law would protect them, trusted that markets function fairly, they learned otherwise. The system changed the rules. The contracts they owned became worthless, and the metal they should have received was kept by the shorts who couldn't deliver. The COMEX controls silver prices through paper leverage. That's the reality. How much longer that control lasts depends on how much longer confidence holds. And confidence, once broken, doesn't return. Inside the COMEX, the machine runs on leverage and promises. 113 million ounces of metal backing, 650 million to 900 million ounces of paper. It's worked for decades, until maybe it doesn't.